Welcome to the debate. Today, we are analyzing the state reserve banks within the Wadsworth economic simulation to determine which institution offers the absolute best strategic value for bond investors.
Right, because the simulation provides this incredibly robust, hard-coded financial ecosystem.
Exactly. And the central disagreement we are exploring today really comes down to fundamentally different philosophies on how to navigate it. I mean, should players prioritize the structural invulnerability and transactional efficiency of a stable base currency? Or should they exploit extreme volatility and high-yield mechanics for maximum capital appreciation?
It's a fascinating sandbox. We are dealing with risk and reward governed by uncompromising algorithms here.
We are. And this debate emerges directly from the economic rules, the bond mechanics, and the forex dynamics written into the simulation's reserve bank system. I will be arguing that the Federal Reserve of Wadsworth and its USD is the objectively superior reserve bank due to its fixed peg and absolute stability.
And I'll be championing the central bank of the Wadsworth Republic and its TYR currency as the optimal vehicle for active capital growth and systemic exploitation. I'm really looking forward to tearing into the specific parameters that define these two very different banking strategies.
Let's begin by establishing the baseline for the Federal Reserve of Wadsworth and the USD. In any economic system, simulated or real, foundational stability is paramount if you're looking to preserve and reliably grow wealth. The USD serves as the bedrock of the entire Wadsworth simulation. The core mechanic establishing this dominance is the fixed peg. One Wadsworth stablecoin, or WSC, is strictly pegged to one USD. The exchange rate is permanently fixed at 1.0.
Which effectively eliminates any forex speculation on the base currency.
Exactly. You are never guessing what your underlying principal is worth when denominated in the simulation's base value. Furthermore, the USD Bank offers a highly respectable initial yield of 5.3%. That yield floats within a constrained, very predictable band, from negative 0.5% up to a maximum of 25%.
Sure, but...
And just to finish that thought, by choosing USD, an investor makes themselves completely immune to the FX yield link penalty. In this simulation, rising yields actively depreciate a currency's value. By holding USD, you bypass that entire line of code. You preserve your wealth, avoid all transactional friction, and lock in a stable hourly interest rate that compounds flawlessly over the 8,760 ticks in a simulation year. It is the only logical choice for an investor looking for reliable growth without exposing their principal to existential risk.
I hear ya. The USD is structurally safe, certainly, but in a simulation governed by hard-coded parameters, prioritizing safety to that degree means leaving mathematically verifiable massive returns on the table. The central bank of the Wadsworth Republic, which issues the TRY currency, is the superior reserve bank for players who truly understand how to manipulate the game's mechanics.
Manipulate or gamble with.
Exploit the mathematical rules as they are written. Let's look at the raw numbers here. The TRY Bank offers a staggering 40% initial yield. It operates with a hard floor of 10% and a massive ceiling of 99%. The simulation utilizes dynamic yield and forex mechanisms, where increased bond demand pushes yields down. Crucially, that downward yield pressure simultaneously causes the currency to appreciate. We are looking at an environment where the massive initial hourly interest accrual outweighs the underlying risks. It offers an unprecedented opportunity for dual-layered profit. You earn massive interest on the front end, and then you ride the currency appreciation to a substantial capital gain on the back end.
The dual-layered profit theory sounds really appealing on paper, but looking at the yield in a vacuum drastically underestimates the severity of the forex risk. We need to dig into the USD per unit dynamics. You mentioned the 40% yield, but you cannot ignore the FY yield link mechanic. The code dictates a 0.5% fractional change in the currency's USD value for every 1% shift in yield.
Which is a highly aggressive inverse correlation, yes.
It is remarkably aggressive, and we have to look at the starting conditions. TRY begins at a remarkably weak $0.029 per unit. Because it's a volatile currency designed to attract high-risk players, sell-offs are inevitable. When players sell their TRY bonds to take profits or panic exit, the net demand goes negative. When demand goes negative, the yield spikes.
But you are modeling a scenario based entirely on panic selling.
I am modeling capital destruction. If a panic pushes the TRY yield toward its 99% maximum, the currency hyperdepreciates. The algorithm will brutally devalue the TRY. You might be accruing a 40% or 60% interest rate on your bonds, but the actual purchasing power of that accrued interest, when you finally convert it back to WSC or USD, is entirely wiped out by the depreciation of the principal. You are catching a falling knife. The core takeaway here is that high-yield banks in this simulation aren't actually investment vehicles. They are volatile momentum trades where you are betting against the mathematical gravity of the FXY yield link.
The flaw in that modeling is that it assumes irrational player behavior in a highly rational, totally transparent system. The inverse dynamic you just described is exactly why TRY is the most powerful wealth generation tool in the game. Let's trace the actual capital flow when players are presented with a 40% yield. The yield reacts to net WSC flow. The code defines a parameter called yield sensitivity.
The yield sensitivity variable?
Correct. Think of it like a highly calibrated scale. For every $1,000 of demand placed on that scale, the yield ticks down by a microscopic fraction, specifically 0.00001. It sounds tiny, but at the macro scale of a simulation-wide bond market, it dictates everything. When sophisticated players see a 40% yield, there will be a surge in buyers wanting to lock in that return. That massive influx of WSC to purchase TRY bonds rapidly drives the yield down from 40%. Because of the FXY yield link, that falling yield triggers immediate currency appreciation.
Assuming the buying pressure outpaces the underlying structural weakness of the TRY bank.
Yields massive early interest in those first few hours and days. That is followed immediately by a surge in the principal's value when the currency strengthens due to the demand. You capture the high yield, and the very act of the broader market chasing that yield creates your capital appreciation. It's a self-fulfilling cycle of profit hard-coded into the system.
If we look strictly at the code, realizing those profits introduces a massive amount of structural friction. The simulation imposes severe penalties on foreign currencies when you attempt to actually use them. Whenever you engage in cross-currency payments, or when your income is processed, the system applies a 0.2% Forex rate on all auto conversions.
A fraction of a percent.
A fraction of a percent applied constantly. If you're constantly shifting in and out of TRY to capture these capital gains, that 0.2% auto conversion fee bleeds your alpha dry daily. Furthermore, some players might attempt to circumvent this friction by simply switching their legal tender from USD to TRY within the simulation.
Which would be a tactical error.
It would be catastrophic. The simulation traps you if you do that. There is a tender switch cooldown days parameter strictly set to 7 days. Worse, there's a deeply punitive 2% tender switch fee rate applied to all your existing foreign balances when you attempt to repatriate your funds back to a stable currency like the USD. But choosing TRY, you aren't just taking on market risk, you are taking on profound structural liquidity risk. The USD avoids all of this. It operates with zero transactional friction. Your capital is always perfectly liquid.
You're conflating the adoption of a transactional currency with the utilization of an investment vehicle. A player absolutely does not need to adopt TRY as their legal tender to buy its bonds. As you noted, that exposes them to unnecessary friction. The optimal, mathematically sound strategy is to maintain your legal tender as USD. You simply use your Wadsworth stablecoin, your WSC, to purchase the TRY bond. You collect the interest natively in the foreign currency over the life of the bond. You do. But we have to look at the scale of the returns. A 2% repatriation fee is mathematically negligible when you are generating 40% annualized returns. Crucially, That interest is compounded hourly. The simulation runs 8,760 ticks in a year. The compounding effect of a 40% yield over 8,760 hourly ticks completely dwarfs a one-time 2% exit fee. The friction isn't a barrier, it's just the cost of doing business in a high-velocity environment. Paying a 2% toll is totally irrelevant when the capital velocity is that high.
The assumption that you will be able to compound that 40% yield over 8,760 ticks ignores a critical safeguard built into the reserve banks. We must address the call provision paradox. The simulation doesn't guarantee you can hold that bond to maturity. The code includes a bond call yield threshold.
The forced redemption mechanic.
Exactly. If a reserve bank's current yield drops to 40% or less of the bond's original purchase yield, the bank has the algorithmic authority to force redeem the bond early. High-yield banks like TRY are engineered to be highly volatile, driven by the massive demand swings you just outlined as a positive. Because of that volatility, early forced redemption is not just possible, it is highly probable.
And that is exactly what a TRY bondholder wants to happen.
How is having your compounding engine shut off a positive outcome? If you buy at 40% and the market rushes in, driving the yield down to 16%, the bank calls your bond. Your strategy of locking in a 365-day maturity to compound your wealth over 8,760 ticks is abruptly terminated. The system strips you of the asset precisely when it begins performing exactly as you predicted.
That forced redemption is a structural advantage, not a penalty. You have to look at the specific parameters of how the simulation handles a call. The code enforces a bond call premium mechanic. When the central bank forces you out of your bond, it doesn't just hand you your principal back. It is mathematically forced to pay a 3% bonus on the face value of the bond.
A 3% bonus on the face value. Yes, but you lose the future yield.
You don't need the future yield because the capital appreciation has already occurred. Let's walk through the exact sequence of a call event. You buy TRY at the 40% yield. The market rushes in, as it mathematically should, driving the yield down to 16%. Because the yield dropped by 24%, the FX Wild link ensures the TRY currency has simultaneously appreciated massively against the USD. The bank hits the threshold and triggers the call provision,
Ending your position?
ending the position at the absolute peak of its value. What exactly happens at that tick? You receive your principal back in a currency that has just experienced massive appreciation. You keep all the 40% interest you accrued before the call was triggered, and then the simulation instantly applies a 3% capital bonus on top of your face value. Getting called out of a TRY bond is an accelerated liquidation event. It realizes your capital gains instantly, awards you a premium, and frees up your liquidity to immediately hunt for the next mispriced asset in the simulation.
That scenario relies entirely on the market perpetually bailing out the TRY bank by driving demand up and yields down. It assumes infinite liquidity and infinite demand. We have to consider what happens when player demand softens. Let's examine the mechanics of interbank debt and systemic collapse.
The insolvency protocols.
Yes. The simulation enforces a bank min reservation. If a reserve bank's foreign reserves fall below 5% of its outstanding liabilities, it triggers an immediate interbank debt scenario. The system applies a debt yield penalty, raising yields by 0.1% per $1,000 of net debt. High-yield banks are disproportionately prone to these systemic debt spirals.
Because they are paying out massive amounts of interest.
Precisely. They are bleeding currency at 40% annually, compounded hourly. If player demand for TRY bonds softens, even slightly, the TRY bank will blow right through that 5% reserve ratio. When the debit yield penalty kicks in, the yield artificially inflates. As the yield inflates, the FY yield link aggressively devalues the TRY currency. It creates a systemic death spiral. The bank's own debt obligations permanently destroy the purchasing power of anyone holding its bonds. The USD bank, with its stable 5.3% yield and massive foundational reserve base, will never trigger this penalty. Wealth preservation requires avoiding institutions that are mathematically programmed to flirt with insolvency.
The debt spiral is a mathematically severe threat, but you are omitting the simulation's ultimate systemic safety net. The system is designed specifically to prevent total sovereign collapse through the daily WSC liquidity swap, once every 24 hours, exactly every 17,280 ticks. The reserve banks run an automated process to convert their WSC holdings into currency reserves.
Which is essentially the simulation's version of central bank overnight lending.
Exactly. Now look at the specific parameter for banks in distress during that swap. Banks with urgent reserve shortfalls earn a 0.5% premium, designated as the daily swap urgency premium, designed specifically to attract liquidity. The simulation fundamentally subsidizes high-yield banks. When the TR bank hits that dangerous low reserve threshold, the daily swap injects premium liquidity. This stabilizes the reserve ratio and breaks the debt spiral before it can permanently wipe out the currency.
But the DEBTYLD penalty applies continuously. It takes up every single hour. The bailout you're describing only arrives every 17,280 ticks.
And the premium injected during that swap is substantial enough to reset the board.
Assuming the bank survives to tick 17,280 without the currency's value approaching zero. Relying on a daily liquidity premium to outpace an hourly compounding debt penalty is an incredibly precarious way to manage capital. Between those liquidity swaps, a tribe portfolio could experience catastrophic volatility.
Volatility is the mandatory price of alpha in this system. If an investor wants the returns of a foundational checking account, they absolutely should stay in the USD. But if they want to grow their net worth exponentially, they must engage with the volatility of the TRY. The hard-coded bounds of the simulation, the liquidity swaps, the yield sensitivity constraints are designed to prevent absolute zero. The risk is heavily socialized across the simulation's banking sector, but the massive 40% reward remains privatized in the hands of the TRY bondholder.
As we review these opposing frameworks, we must evaluate the mathematical realities of the simulation against an investor's ultimate objective. I maintain that the Federal Reserve of Wadsworth is the definitively superior choice for an investor prioritizing structural integrity.
Because of the peg.
Because the fixed 1.0 exchange rate of the USD completely neutralizes the downside of the FXY yield link, it provides total immunity to the 0.2% auto-conversion bleed and the punitive 2% repatriation fees. That ensures your wealth remains fully liquid and easily deployed. A floating 5.3% yield compounding hourly over 8,760 ticks provides exceptional, predictable growth without subjecting your portfolio to the whiplash of interbank debt penalties or unpredictable forced call provisions. The USD Bank is the ultimate vehicle for wealth preservation and transactional efficiency.
And I maintain that the central bank of the Wadsworth Republic, precisely because of its structural volatility, is the objectively superior choice for aggressive capital growth. A baseline 40% yield is mathematically unparalleled in the simulation. When you combine that yield with the ability to weaponize the bond call premium for a 3% instant capital bonus and the strategy of riding the inverse Forex link for rapid currency appreciation, TRY offers a compounding engine the USD simply cannot match. The daily liquidity swap provides the necessary structural floor, allowing sophisticated investors to exploit the high-yield mechanics without the threat of permanent erasure.
Ultimately, determining which reserve bank offers the best strategic value depends on whether a player requires a secure, foundational asset base or a highly aggressive, mechanics-driven momentum trade.
The simulation mirrors real-world sovereign debt markets perfectly in that regard. It's worth noting that for investors who find the USD too static and the TRY too volatile, the system offers middle ground institutions. Analyzing banks like the Wadsworth Bank of England or the Wadsworth National Bank might allow players to find a more calibrated position on the risk-reward curve.
The mechanics we have detailed today apply to all institutions across that spectrum. The underlying mathematics of the simulation are absolute, but the execution of the strategy remains in the hands of the individual investor. We will leave it to our listeners to evaluate the parameters and determine which side of the ledger aligns with their objectives. Thank you for joining us on the debate.